Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another little deep dive. Today, we're breaking down a company that's truly fascinating, quietly underpinning so much of our modern world, Schneider Electric SE.
That's right. It's a giant, but maybe not one everyone immediately thinks about.
Exactly. And the real question for us today, the thing we really want to unpack is this. Is Schneider Electric successfully powering the digital future, solidifying its fortress, or are there maybe hidden cracks, some vulnerabilities that the market might be overlooking? That's what we're here to find out.
That's a massive question. And before we jump right into the details, just a quick note for everyone listening.
Yeah, absolutely.
Those of you who want to act on these investing ideas, having a professional-grade platform is really key. We use interactive brokers. And, well, we've partnered with them to get our listeners a stock bonus when they sign up.
So you get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And, of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like. It genuinely helps the channel grow.
Definitely. And if you have questions about Schneider or anything else we discuss, please, manifest yourself in the comment section. We do read them.
We do.
Perfect. Okay, let's get into it. Pillar number 1, the business model. So, Schneider Electric. The name's familiar, but let's unpack what's really going on inside this industrial heavyweight. How do they actually, make their money day to day? What's the core problem they solve?
Right. So at its heart, Schneider Electric's mission is actually, well, surprisingly straightforward, but incredibly powerful. They empower their customers to use energy and resources much more efficiently and sustainably.
Okay.
Their whole life is on. Philosophy really captures that. Think of them as the architects and providers of the absolutely critical infrastructure that manages electricity.
From grid to plug, basically.
Pretty much. From the moment it leaves the power grid, right up until it's used by, an office building, a huge data center, a factory, or even city infrastructure. And they do this with a really integrated portfolio. It spans hardware you can touch, software that controls it all, and the services needed to keep everything running smoothly.
Got it. So how does that break down into actual business segments? Where's the revenue coming from?
Yeah, good question. It helps to look at their two main business segments. First, and this is the bigger sort of foundational piece, is energy management.
Okay.
This segment handles pretty much everything related to distributing and controlling electricity. So, those electrical panels and circuit breakers you find in basically every building, especially in North America.
Square D. Right?
Exactly. Square D is a powerhouse brand under Schneider. And if you need reliable power backup for critical IT systems, think hospitals, banks, data centers, APC, precisely. Another dominant name, especially in uninterruptible power supplies or UPS systems, that's also part of energy management. So this is where Schneider interfaces most directly with those big end markets. Buildings, data centers, infrastructure projects.
And that's the larger segment.
By far. And it showed its strength in fiscal 2023, grew a really robust 14% organically.
Yeah.
That signals very strong demand for that essential electrical gear.
Okay, so that's energy management. What's the other piece?
The second major segment is industrial automation. Now, this is about helping factories and industrial processes run smarter, more efficiently.
Right, the factory floor stuff.
Exactly. We're talking sophisticated tech here, like programmable logic controllers, PLCs, which are basically the brains of automated systems. They also do things like variable speed drives, which precisely control motors, and a whole range of other control systems that boost efficiency, safety, and reliability in complex manufacturing.
And who buys this?
A wide range of industrial clients. Everything from, say, discrete manufacturing, making individual items, to process automation, like in chemical plants or water treatment facilities where things flow continuously. This segment also delivered solid growth, about 7% organically in fiscal 2023. So both core areas are performing well.
That's a great overview of the what, but you mentioned earlier something about a strategic evolution, how they make money. Sounded like a shift away from just selling boxes.
Absolutely. And this is, I think, really crucial for understanding where they're headed. Traditionally, a big chunk of Schneider's revenue, like many industrial firms, came from just selling individual hardware components.
The nuts and bolts.
Right. They call these products. And that was still about 53% of their revenue in fiscal 2023. Things selling a single circuit breaker, a sensor, whatever. It's important, but it's transactional.
Okay.
But then you have systems, which made up 28% of revenue. Now, this isn't just selling one piece. This is integrating multiple products, hardware, software services into a complete solution for a specific project.
Like outfitting a whole building.
Exactly.
Yeah.
Imagine putting the entire electrical distribution, power management, and building automation system into a new hospital. That's a system sale.
Got it.
And here's the key bit. This system segment is growing much faster than standalone products. In Q4 2023, it grew 17% organically. That's a really clear signal that customers increasingly want these integrated, all-in-one solutions. They don't just want a part, they want the problem solved.
That makes sense. Less hassle for them.
Precisely. And then finally, you get to software and services. This is about 19% of revenue in fiscal 2023. And arguably, this is the most strategically important category. It's also by far the highest margin.
The recurring revenue piece.
Exactly. This includes powerful industrial software platforms, often with recurring revenue, especially through their subsidiary AVEDIA. It also covers essential field services, installation, maintenance, upgrades, that kind of thing. This deliberate shift towards a higher mix of software and services is absolutely key. It's moving them towards stickier, more predictable revenue, and fundamentally changing their economics for the better.
So it really does sound like they're trying to build maybe not just the picks and shovels, but the whole mine infrastructure for this digital age. How simple, and maybe more importantly, how enduring is that core business model, especially with technology changing so fast?
That's a great way to put it, building the infrastructure. And you're right to ask about endurance. Despite the complexity of the tech they deploy, the underlying business model is, well, remarkably simple, and I'd argue incredibly enduring.
How so?
Think about it. Our world runs on electricity, period. Consumption keeps growing, but at the same time, there's immense pressure, economic, environmental, to use it efficiently, sustainably.
Right.
Schneider provides the fundamental, non-discretionary picks and shovels to manage that whole equation. Every building, every factory, every data center needs the stuff Schneider sells to distribute, control, and optimize power safely. It's not a fad. It's essential infrastructure.
Okay, so it's fundamental, but what about those big global shifts? Do they help or hurt?
They massively help. The endurance of this model is underpinned by these powerful secular megatrends that are mostly independent of normal economic cycles. That makes the business very robust.
Like what specifically?
Okay, first, electrification. This huge structural shift away from fossil fuels towards electricity. Think EV charging everywhere, heat pumps in buildings, industries cleaning up their energy use. This electrification of everything requires a massive build-out and upgrade of electrical infrastructure at every level. That directly expands Schneider's market in a profound way. They sell the gear needed for all of that.
Makes sense. What else?
Second, digitalization, especially now supercharged by AI. The cloud, the internet, all our digital services, they live in data centers. And AI, it's driving an unprecedented boom in data center construction.
And those things use a lot of power.
An incredible amount of power. They're like small cities. Schneider isn't just playing in this space. They are a dominant global supplier for the entire electrical architecture of these data centers, from the big switchgear connecting to the grid right down to the critical power and cooling inside. Their recent partnership with NVIDIA, just co-developing data center designs, really highlights how indispensable they are in this absolutely critical ecosystem.
Wow. Okay, electrification, digitalization. What's the third leg?
Sustainability and efficiency. Rising energy costs, pressure to decarbonize it, forcing organizations everywhere to cut energy waste.
Right, it's not just optional anymore.
Exactly. And Schneider's core value proposition hits this directly. Their smart products, their software platforms, they provide the tools to monitor, control, optimize energy use. They turn this global imperative, save energy, go green, into a durable long-term business driver for themselves.
Okay, so those trends are strong tailwinds, but you mentioned that strategic evolution, the digital flywheel. How does that fit in?
Ah, yes, the digital flywheel. This is critical for their long-term value. It's their term for the combination of connectable products, edge control software, stuff running locally, and their higher-level digital services and analytics.
Okay.
The key thing is this digital flywheel now accounts for 56% of their total revenue. And, importantly, it's growing faster than the rest of the company.
So it's becoming the core of the business.
It really is. And it fundamentally changes their economics. It shifts them towards those higher-margin recurring software and service revenues. But maybe even more importantly, it significantly deepens their competitive moat by massively increasing customer switching costs.
How so?
Because it's not just about selling a product anymore. It's about embedding an entire system. They're essentially building an operating system for the physical world, for buildings, for factories. That makes them far more indispensable than a simple hardware supplier ever could be.
An operating system for the physical world. That's a powerful idea. So if they're becoming that essential, what stops competitors from just copying them or muscling in? What's the economic moat here, and how do we actually see it protecting them?
Right, the moat. It's primarily built on high switching costs.
Yeah.
And that's powerfully reinforced by their intangible assets, like strong brands.
So it's not just one magic product.
No, definitely not. It's the deep integration. Their products, software, services, they get woven into the absolute mission-critical workflows of their customers. Once a facility, a factory, hospital, data center is built using Schneider's architecture, ripping it out and replacing it with a competitor system. The cost, the disruption, the technical risk, it's just prohibitive most of the time.
Like trying to change the plumbing in a fully occupied skyscraper.
Exactly that kind of problem. It's often nearly impossible without huge expense and risk.
Okay, switching costs. What about the intangible assets? You mentioned brands.
Yes, big time. Think about Square D in North America for electrical panels, or APC for critical power, or AVEVIA for industrial software. These aren't just names, they're industry benchmarks.
People trust them.
Immensely. For decades, electricians, engineers, IT pros, they've been trained on these products.
Yeah.
They trust them for reliability, safety, especially in critical applications. So when a new project comes up, guess what often gets specified by default?
Schneider gear.
Often, yes. It creates a powerful barrier for competitors. Plus, they have a huge patent portfolio, over 20,000 patents. That protects their specific technologies, too.
That makes sense. Intuitively, the deeper you're in, the harder to replace. Can you give us a really concrete, real-world example? Show us the moat in action.
Sure. Let's use their EcoStruxure platform in, say, a new energy-efficient office tower.
All right.
The electrical contractor, who's probably used Square D for years, specifies their smart panel boards. Reliable, easy to install.
Yeah.
Meanwhile, the IT department needs zero downtime for servers, so they mandate APC UPS systems and maybe some advanced cooling.
Standard practice.
Right. And the facility manager, chasing sustainability goals, wants a sophisticated building management system, BMS, to control HVAC, lighting, everything intelligently.
Okay, lots of different pieces.
Exactly. Now here's where EcoStruxure comes in. It's not just a collection of products. It's the digital backbone, the IoT architecture that connects all these systems.
The integration piece.
Precisely.
Yeah.
Those smart panels, the UPS units, sensors everywhere, the HVAC controls, they all feed data into the EcoStruxure software. The facility manager gets one unified interface.
One dashboard to rule them all.
Kind of. They can monitor energy use in real time, get predictive maintenance alerts before things break, automate efficiency routines like dimming lights based on daylight.
And that saves real money.
Potentially huge amounts, maybe 75% on maintenance costs, 80% on engineering time, according to some of their case studies. Real quantifiable benefit.
Okay, so now the moat part. What if a competitor comes along?
Right. Say Siemens or Eaton offers a slightly cheaper UPS. To swap out that APC unit isn't just hardware. It means ripping a hole in that integrated EcoStruxure platform.
Yeah.
The cost isn't just a new box. It's software reconfiguration, retraining staff, and crucially, the operational risk of messing with a critical system in a working building.
Yeah, nobody wants to risk that.
Exactly. So this integrated ecosystem actively repels competitors, and it gives Schneider pricing power on service contracts and future upgrades in that same building. It's a very sticky web.
That's a powerful picture, a fortress, like you said. And you mentioned the moat is actually widening. How's that happening? Are they actively strengthening it?
Oh, absolutely. They're very active. It's not happening by accident. It's the direct result of executing that digital flywheel strategy we talked about. It's designed to deepen that customer lock-in.
How does the flywheel do that?
Well, the pieces work together. More of their hardware is now sold connected.
Yeah.
That feeds data into local edge control software. Then, cloud analytics and services extract more value, giving customers actionable insights. So every time a customer adds another connected Schneider device, it makes the whole EcoStruxure platform more valuable to them, making the entire system stickier, raising those switching costs even higher. It's a virtuous cycle.
And the numbers back that up.
Yeah, the fact that the digital flywheel share of revenue keeps growing 56% in H1 2024, expected to hit 60% in H1 2025. And it's growing faster than the rest of the company. That tells you customers are buying into the whole ecosystem, not just parts. Plus, those strategic acquisitions fully integrating AVEVA for industrial software, buying Motivair for specialized data center cooling, these aren't random. They're targeted moves to expand the ecosystem scope and make that moat even wider and deeper. They're adding missing pieces to the puzzle.
It's not just the tech, though, is it? You mentioned partners.
Crucial point. The moat is also embedded in the industry's practices. Schneider uses this huge network, over 15,000 distributors, panel builders, system integrators globally.
The people who actually install this stuff.
Exactly. These partners invest heavily in training their people on Schneider's specific products and software. So when they design a new project, what do they naturally lean towards?
What they know and trust. Schneider.
Precisely. It creates this powerful, self-perpetuating channel advantage. It's incredibly hard for a competitor to replicate because you'd have to convince and retrain this whole ecosystem of independent businesses. It's a real-world network effect.
That paints a very strong picture of competitive advantage. But, every fortress might have a vulnerability. What's the biggest external threat? What keeps Schneider's leadership up at night? And also, let's bring in the human side. How do customers actually feel about Schneider? And what's the internal culture like? Does that support this moat narrative or challenge it?
Critical questions.
Yeah.
Because, even the strongest face challenges, and how people feel inside and out tells you a lot. Let's start with customer sentiment. It's actually pretty nuanced.
Yeah.
It ranges from maybe tolerated in some areas to genuinely loved in others. And there's a difference depending on whether you're a big enterprise or a smaller user.
Interesting. Tell me more.
For their large-scale, complex solutions, especially for big enterprises, Schneider is highly regarded. You look at reviews for their data center infrastructure management, DCIM tools, on places like Gartner, overwhelmingly positive.
What do they like?
Powerful features for asset tracking, capacity planning, and they praise the support team's expertise. Lots of case studies show real benefits, boosting plant throughput, big energy savings. These large clients see Schneider as an essential partner, which definitely reinforces that moat idea.
Okay, so the big guys are happy. What about others?
Well, when you look at industrial automation customers, the feedback gets more mixed.
Oh.
In some technical forums, you'll find experienced users describing certain software platforms as, complex, sometimes buggy, even a headache. A common theme is that some software feels built by engineers, for engineers, meaning super powerful if you're an expert, but maybe a steep learning curve if you're not.
So not always user-friendly.
That seems to be the critique in some specific areas. It suggests that while the idea of integration is great, the execution on every single piece of software might not be perfectly seamless yet for everyone.
Okay. What about the consumer stuff? APC, Square D?
Generally positive, but not perfect. Square D panels and breakers, consistently seen as reliable, the industry standard, high quality APC UPS systems, valued for doing their main job, keeping the power on during outages. But you do see a minority of reviews mentioning issues with battery life, sometimes the software isn't great, or occasional quality control slips.
So good, but maybe not flawless.
Pretty much. Their overall Net Promoter Score, NPS, is 32. That's respectable for an industrial firm, but it does lag behind Siemens, who are at 36.
Interesting comparison.
But customer loyalty seems strong, 78% user loyalty. And you can see they are investing in improving the customer journey. New digital tools, better support. So they seem aware of these friction points.
That's a fascinating split. Strong enterprise love, but some grumbles elsewhere. What about the view from inside, the employees? How does that fit?
Right, the internal perspective. Schneider is widely seen as a high-quality employer. Very stable, mission-driven culture.
Like a good place to work.
Very much so. Frequently wins Best Place to Work awards. Glassdoor rating is high, 4.3 out of 5. CEO approval is exceptional, 96%. And 89% of employees would recommend working there.
Wow, that's strong.
Yeah. People praise the positive culture, great benefits, the genuine focus on sustainability, good work-life balance, lots of long-term employees, which suggests stability and deep institutional knowledge, a huge asset for a company like this.
Are there any downsides mentioned?
Sure, the usual things you hear about large global companies. There's some bureaucracy, maybe inconsistent management quality between different divisions or regions. Compensation for some technical roles might not be absolute top tier compared to, say, pure tech firms.
Standard big company stuff.
Mostly. But there was one particularly telling comment I saw, which ties back to the customer feedback. An employee mentioned how the growth by acquisition strategy can sometimes lead to a disjointed organization and product line.
Ah, the integration challenge again.
Exactly. Internally, that creates challenges. And connecting the dots, that divergence in customer feedback, praise for the big integrated systems, mixed reviews on specific software, it directly reflects this strategic journey. The success with big systems validates the strategy and the moat, but those friction points, like the software complexity, those are real risks. And that employee comment about a disjointed product line internally confirms this external challenge. It highlights a key area management really needs to nail to deliver on that seamless operating system promise.
Okay, moving from the business itself to the people running it and the financials. Let's talk leadership and capital stewardship. How are they managing the company's resources? Are they making smart moves?
Yeah, fundamental question. And there was a significant, maybe even slightly abrupt, leadership change recently. In November 2024, the CEO, Peter Herweck, was replaced after only about 18 months.
That sounds fast for a stable company like Schneider. Why?
Well, a quick change like that does raise eyebrows. The board's official reason was divergences in the execution of the company roadmap and a misalignment in management style. Importantly, they stressed it wasn't about the strategy itself.
So execution issues.
That's the implication. And what's interesting is this happened during a period of strong financial results. It suggests the board acted preemptively, like they saw this huge market opportunity ahead and demanded flawless execution, maybe wanting to move even faster.
So who took over?
The successor is Olivier Blum, and his appointment signals strong commitment to strategic continuity. Blum is the ultimate Schneider insider.
Oh, so?
He's been with the company for over 30 years. Held critical global roles, Chief Strategy and Sustainability Officer, Chief HR Officer, and most recently, he ran Energy Management, their biggest business. He knows the company inside and out.
Okay, so a safe pair of hands, deeply familiar with the strategy.
Exactly. His public statements are all about electricity 4.0, converging digital and electrification for net zero. He talks about a replace, electrify, reduce framework. It's the language of someone focused on the long-term existing vision.
So the board basically doubled down on the current strategy, just wanting faster, smoother execution under an insider.
That seems to be the message. It's a vote for continuity and speed, not a pivot.
Okay, leadership seems focused. What about how they allocate capital? Are they good stewards for shareholders?
Their track record here looks very disciplined, transparent, and focused on long-term value. They have clear priorities, stated in order.
Which are?
1, strong investment-grade balance sheet. 2, fund organic growth R&D CapEx. 3, value-accretive acquisitions. 4, shareholder returns via dividends and buybacks.
Do they invest enough back into the business? R&D.
Seems so. R&D was about $1.4 billion back in 2022, for example. That's what fuels platforms like EcoStruxure, strengthening that moat. It's investing in their future advantage.
And acquisitions, you mentioned EVIA and Motivair. Do those fit the strategy?
Very much so. They have a history of using M&A strategically, and recent deals fit perfectly with deepening that ecosystem moat. The full AVE acquisition, about $9.5 billion, finalized in 2023, was huge.
Why AVA?
Industrial software leader. The rationale was clear. Create a unified data platform, combining operational and energy data, and accelerate Schneider's shift to that higher margin recurring software revenue, more sticky income.
And Motivair.
That was $850 million in 2025. They specialize in advanced liquid cooling. That's a direct tactical move for the booming AI data center market. It strengthens their whole grid-to-chip and chip-to-chiller offering, a key differentiator there.
Makes sense. Any other big moves?
Yeah, taking full control of their Indian operations in 2025. That was a $5.5 billion deal for the remaining 35%. India is their third largest market, seen as a critical global hub for manufacturing, R&D, growth. Full ownership just streamlines things.
Okay, acquisition seems strategic. What about returns to shareholders? Dividends, buybacks?
Strong commitment here. They have an unbroken 15-year record of a progressive dividend policy. They even propose an 11% increase for fiscal 2024.
Is it affordable?
Yeah, it's well covered. The payout ratio is typically around a healthy 50% of earnings. They also do share buybacks, but the dividend seems to be the main tool for returning capital.
So overall assessment of capital allocation.
Highly rational, I say. Very shareholder friendly. Acquisitions aren't just empire building. They target tech and markets that reinforce the core competitive advantages. The dividend track record is excellent.
And the CEO change fits into that.
Viewed in this context, yes. It looks less like instability and more like an intense focus on flawless execution of a clear strategy, especially with this massive market opportunity in AI and electrification. Appointing a 30-year veteran to run the show emphasizes accelerating that path.
A strong leadership team is vital, agreed. But ultimately, the numbers tell the story. How robust is Schneider Electric's financial fortress? Are they just growing? Or growing profitably and efficiently?
The financials paint a very clear picture. This is a reliable, consistent earnings machine.
Okay. Steady growth.
Very steady. Over the last 5 years, revenue CGR was 9.1%, but earnings grew even faster, 13.8% CAGR. It tells you margins are expanding. They're getting operating leverage. Profits growing faster than sales.
What about resilience? How do they handle, say, the pandemic?
Impressively well. In 2020, revenue only dipped about 7.4%. Modest, really. And then they rode back with nearly 15% growth in 2021. It shows how non-discretionary their stuff is.
Right. The world still needed power and data.
Exactly. And fiscal 2023 was a record year. $36 billion in revenue, up 13% organically. And free cash flow jumped a remarkable 38% to $4.6 billion. They convert sales into actual cash very effectively.
So the top line and bottom line look good. What about the underlying quality, key financial ratios?
Yeah, the ratios really confirm the quality. Highly profitable, cash generative, prudently managed. Let's hit a few key ones.
Go for it.
First, return on invested capital, ROIC. This is arguably the gold standard for measuring business quality, how well they use capital to generate profits.
And Schneider's ROIC.
It's strong and, importantly, improving. It went from 8.0% in 2020 up to 10.6% in 2023 and 2024.
So they're getting better returns on their investments.
Exactly. It's consistently above their cost of capital and expanding. Clear evidence of that durable competitive advantage and value creation. They're getting smarter with their money.
Okay, ROIC is good. What about cash generation?
Free cash flow conversion. How much accounting profit turns into real cash? Schneider is exceptional here.
How?
Their FCF to net income ratio is consistently at or above 100%. Averaged 119% over the past 5 years. Fiscal 2024 was 99%. It means the reported profits aren't just paper profits, they're backed by a torrent of actual cash. Very high-quality earnings.
That's reassuring. What about the balance sheet? Debt.
Fortress-like, that's the word I'd use. Their key leverage ratio, net debt to EBITDA, is very prudent.
How low?
Comfortably below 2.1x over the last 5 years, stood at a very conservative 0.9x at the end of 2024.
Yeah, that's low.
It is. It gives them a huge margin of safety. They can handle downturns easily and have the financial flexibility to jump on strategic opportunities like those acquisitions without taking on undue risk. It lets them play offense.
Okay, so summing up. High-quality business, strong and widening moat, focused management, robust financials. This brings us to the crunch question for investors. What about the price? Is this quality already fully baked in? Is the valuation justified, or are we potentially paying too much?
Ah, yes, the $1 million or maybe $1 billion question. Balancing quality and price. As of mid-2025, Schneider's trading at a trailing 12-month PE ratio around 30.1x.
Okay.
And its price-to-free cash flow ratio is very similar, about 29.9x.
How does that compare historically?
Definitely at the higher end of its own range.
Yeah.
The PE got down to maybe 21.8x in 2022, peaked around 31.3x in 2021. But the 10-year average PE is significantly lower, more like 23.5x.
So richer than usual.
Clearly, yes. The market's awarding it a higher multiple today than it has historically, on average. You're paying more per dollar of earnings.
And compared to peers, like Eaton or Siemens.
Same story. It trades at a noticeable premium. Eaton's around 24.2x PE, Siemens maybe 23.6x. Schneider's PE is higher.
So what's the judgment call here? Fair price. Too expensive.
I'd call the current price demanding, but likely fair. It's not optically cheap, definitely not. It commands a premium to its history and its peers.
But justified by the quality and growth prospects.
That's the argument. The premium reflects the market, recognizing Schneider's superior quality, that widening moat, and its direct line into those huge secular growth trends, AI, electrification, sustainability.
So an investment now isn't about the multiple going up further.
No, I don't think so. It's a conviction bet. A bet that the company can keep compounding its earnings at an attractive rate for many years. The analysis of the business, the moat, the financials, that provides a strong foundation for that conviction. But it means they have to keep delivering. No room for error at this price.
Understanding that value prop is crucial. So looking ahead, what's the primary engine that's really going to drive Schneider's growth over, say, the next 5 or 10 years? And flipping that, what are the permanent long-term risks? Things that could truly wreck the earning power, not just cause a temporary dip.
Okay, the primary growth engine. While they benefit from multiple tailwinds, the single biggest, most identifiable one for the next 5 to 10 years is absolutely the AI-driven data center build-out.
That AI boom.
It's enormous. Generative AI needs unbelievable amounts of computing power. That means an unprecedented need for new data center capacity globally.
And they're power hogs.
Incredible power hogs. The electrical and cooling infrastructure is a massive part of the cost. And this whole data center market is expected to grow at double-digit rates annually through 2027 at least. That's a massive wave.
And Schneider's position?
Uniquely strong. They're a one-stop shop. They provide the whole end-to-end portfolio, medium voltage gear connecting to the grid, low voltage distribution inside, critical UPS and battery backup, and now, thanks to Motivair, advanced liquid cooling for those super hot AI chips.
That grid-to-chip and chip-to-chiller thing.
Exactly. That comprehensive integrated offering is a huge differentiator.
Yep.
It simplifies a nightmare problem for data center builders. Competitors really struggle to match that breadth and integration.
Okay, that's a powerful growth driver.
Yeah.
Now, the scary part, the permanent risks.
No.
What could really break this company long term?
Right, the permanent impairment risks. There are a few genuine ones. First, systemic cybersecurity failure.
Because everything's connected now.
Precisely. As EcoStruxure connects millions of devices, Schneider becomes a huge, high-value target. Imagine a successful breach using their systems to disrupt critical infrastructure. A power grid, a hospital, a water plant.
Catastrophic.
Absolutely. Reputational damage would be immense, liabilities potentially massive. It could completely undermine their core strategy built on trust and integration. It's an existential risk, honestly.
Okay, cybersecurity. What else?
Second, failure of integration and execution. We touched on this. Their strength, the vast integrated portfolio built through acquisitions, is also a source of immense complexity.
Can they make it all work together seamlessly?
That's the risk.
Yeah.
If they fail to integrate all that hardware and software into a reliable, truly user-friendly platform, the moat erodes. We heard the mixed reviews on some software complexity, the CEO change citing execution. These could be warning signs. It's a massive internal challenge.
Makes sense. One more.
A third, significant long-term threat. Technological disruption by a software-native competitor.
Explain that one.
Imagine a nimble, software-first company, maybe unburdened by legacy hardware manufacturing. They develop a truly open, interoperable operating system for industrial and building infrastructure.
So not locked into one vendor's ecosystem.
Exactly. What if this platform let customers easily mix and match the best hardware from Schneider, Eaton, Siemens, whoever, all under one slick software interface?
That would change things.
It would fundamentally commoditize Schneider's hardware. Their whole ecosystem advantage, the moat, disappears. Integration becomes a liability, not an asset. It's the classic unbundling threat applied to physical infrastructure.
That's a sobering thought. Okay, let's try some second-level thinking now. What's the general market consensus on Schneider? What does Mr. Market think? And where might our deeper dive offer a genuinely different, maybe even contrarian insight?
The market consensus on Schneider right now.
Yeah.
It's overwhelmingly positive, pretty much universally bullish.
How so?
It's seen as a high-quality, well-run industrial leader, perfectly positioned to benefit from those huge secular trends. Data centers, electrification, sustainability, analyst ratings. Mostly buy, or moderate buy. Price targets reflect optimism about continued strong performance. There's not much debate about what's driving growth.
Okay, so the market gets the basic story. Where's the differentiated view then? Are we saying the market's wrong?
Not fundamentally wrong about what will drive growth. The contrarian insight, the deeper understanding, is more about why and for how long this growth could be sustained at such high profitability.
Go on.
The market tends to focus on Schneider, simply selling more stuff into booming markets like data centers. It sees a great industrial company riding a strong cyclical wave. That's valid, but maybe a bit superficial.
And the deeper reality is?
The deeper reality, maybe underappreciated, is that Schneider isn't just a component supplier anymore. They are strategically embedding themselves as a de facto operating system for the physical layer of their customers' facilities.
That operating system idea again?
Yes. The real value, the true durability of the moat, comes from integrating power, cooling, automation, management software into one mission-critical system.
And that's stickier.
Far stickier. Exponentially harder to displace than just a collection of good products. This system-level moat is the source of their enduring pricing power and those high returns on capital. And it will likely persist much longer than the market currently anticipates.
So the market sees a great hardware company in a boom, but the deeper view sees something more like a software platform for industry.
Exactly. It sees a budding industrial technology platform with many characteristics of a wide moat software business. That perception difference suggests a much longer runway for profitable growth than just riding the current data center cycle. That's the key differentiated insight.
Okay, let's synthesize all of this. Time to condense it down. What's the core investment thesis? Give us the bull case, the bear case, and then let's do our red team challenge. The single most compelling argument for why investing today could be a huge mistake long term.
All right, the one-pager summary. The bull case rests on several key pillars. First, they are the essential picks and shovels provider for global megatrends. Electrification, digitalization, supercharged by AI. Sustainability, they are right at the epicenter, providing critical infrastructure. These are multi-decade tailwinds.
Okay, number one.
Well-positioned.
Second, a widening system-level moat. It's built on high switching costs via that integrated EcoStruxure platform, reinforced by iconic brands, Square D, APC, and actively widened by the shift to recurring software and services. It's getting harder to compete.
Number two, strong defense.
Third, exceptional management and financial strength. Experienced, long-tenured leadership with a rational, shareholder-friendly capital allocation record. Plus, it's a consistent cash flow machine with a fortress balance sheet.
Number three, good team, strong finances.
And fourth, durable pricing power. Because their products are mission-critical, the cost of failure dwarfs the product cost. They have significant power to price based on value, not just cost. Customers prioritize reliability. Okay, strong bull case. Now, the bear case. What's the counter thesis?
Several points here, too. First, the demanding valuation. Quality is recognized. The stock trades at a premium. Little margin for safety requires near-flawless execution to justify the price you're paying up.
Risk one, price.
Second, execution and complexity risk. Integrating that vast portfolio of acquired hardware and software is inherently difficult. Failure to deliver a seamless user experience could damage the brand and erode the moat. That disjointed comment is a flag.
Risk two, can they pull off the integration?
Third, the systemic cybersecurity threat. Their connectivity focus makes them a high-profile target. A major breach impacting critical infrastructure is a significant, maybe unquantifiable tail risk. Huge potential liability.
Risk three, cyber attack.
And finally, exposure to cyclical end markets. While data centers boom, parts of their business in industrial and construction are still cyclical. A major global downturn would still hurt segments of their revenue.
Risk four, economic cycles still matter. Got it. Now for the red team challenge. Invert the bull case. What's the single most compelling argument for why buying Schneider today could be a major long-term mistake? What's the hidden killer?
The most potent counter-argument, the real red team challenge, is that the very thing we see as their greatest strength, an integrated ecosystem, actually becomes their Achilles heel.
How so?
The whole thesis rests on that integrated platform being a durable, widening moat. But what if this complex system, built over decades via acquisition, is ultimately too clunky, too closed, too difficult for customers in a fast-moving digital world? We heard those whispers about software complexity.
Okay.
Imagine a future where nimble, software-native companies create that truly open, interoperable operating system for buildings and industry. A platform allowing customers to easily plug and play the best hardware from any vendor, Schneider, Eaton, Siemens, under one elegant open software layer.
The commoditization threat you mentioned earlier.
Exactly. In that world, Schneider's hardware gets commoditized. Their all-in-one ecosystem flips from being an asset to a restrictive liability. Those customer complaints about complexity, the employee comments about disjointedness, maybe those are the early tremors.
So the mistake would be overestimating the moat's durability against software disruption.
Precisely. An investment today is a mistake if we overestimate the staying power of that integrated moat and underestimate the long-term threat of software-driven commoditization, even in the world of physical infrastructure. It's the ultimate innovator's dilemma potentially playing out.
Wow, what a deep dive indeed. We've really navigated the complex world of Schneider Electric, from the nuts and bolts of their business and that powerful moat, through leadership, financials, and that really interesting tension between market perception and maybe a deeper reality.
Yeah, and it leaves us with a really provocative thought to ponder, doesn't it? Consider how this relentless drive for integration, for a seamless digital world while creating huge value, might also be creating new kinds of vulnerabilities, even for these massive entrenched industrial giants. Is the future truly all-in-one? Or will specialization, openness, maybe win out eventually, even for critical infrastructure? It's a fascinating question.
It really is, something for all of you to mull over. Thank you so much for joining us on this deep dive. We genuinely hope you've gained some valuable insights and feel even more informed. Until next time, keep learning, keep questioning, and keep exploring.